How's it going, Ryan?
James, good to see you.
That's very good to see you. How are you doing this afternoon?
Good. Got to the month of October.
We made it.
Yeah. And, look at the Halloween month, and I didn't even keep that wonderful bandage and stuff up
the
there.
prop.
So, yeah, right, exactly. So get rid of it before the Halloween trick, before I scare too many people.
I know, right? Well, October, put a little shiver into some folks.
Scary market environment. You didn't even need a scary Halloween costume. Just, watch the day-to-day movement. And volatility, too. I mean, that was the thing in October.
Right.
It was down on the front end, and then we kind of caught a little bounce and a bid to the to close out the month, so that's good. We saw the S&P 500, top 500 companies in the U.S., it was actually down 2.1%, and tack that on top of September. So truly, we've seen a corrective move in the S&P 500 and the NASDAQ, for those of you who pay attention. And that's just, technically what that is peak to trough 10% movement. Yep. We call them garden variety corrective moves. So it's actually quite healthy for the
routine
and healthy. So again, we did finish that off in the month of October. Bond market did not escape the month unscathed either. We saw the aggregate bond index down 1.58%. So it's just going to be a basket of diversified bonds to give you a general feeling for the bond market. So challenging across the board. And I can point to the culprit, but it'll come out here a little later.
That's all right. Well, and I think we've talked about it before, but I thought maybe after the last couple of years, even the last 2 months you just described, right?
Yeah.
Let's go back into that whole portfolio construction, right? Looking at asset allocation, investment, selection, all those types of things. But let's start at the top right there with asset allocation.
Yeah.
Word that gets thrown around, but how do you use it when we're actually putting together a portfolio?
Well, and truly, this is what separates the mediocre from the best, and just this is how we can really evaluate, how well we're managing money for you and what have you. It's the construction of portfolios. Now, it's not a one-phased process. This is something that there's many layers to it. So you kind of start with asset allocation. And what's going on in the world of asset management, you're trying to take and look at the macroeconomic environment, so the big picture environment, and whether that's, across just the economics, the Main Street, or, looking at corporate financials, that's kind of the Wall Street approach. One way or the other, what you're doing is looking big picture and then coming into the asset allocation that makes sense for a client's risk tolerance, but then also that environment that we're operating in.
Right.
Okay, so we come up with the asset allocation. That's a broad brushstroke.
Yeah. So then if we kind of put that together, let's say it's 60% stock, 40% bond, whatever it might be. The next step would be what? Investment selection?
Bingo. So you come up with this overarching structure. Now you got to color it in.
Right.
If somebody were to tell me that they were all stock for 2023, they'd say, well, you're a professional. I was all stock all year. What do you think my return is? I'd have an answer for them. Don't doubt that for a minute. But the thing is, it's going to be very different if they were invested in the NASDAQ, so the growth tech-heavy, index versus the Dow, which is going to be focused on industrial companies, dividend payers. So again, when it comes to the asset allocation, now that second component is the investment selection within. Just as important as getting the overarching infrastructure correct.
Right.
Now you have to have the right ponies running within that asset allocation.
I see.
So, very important to get that right.
Right. And when you're kind of going through that investment selection, and now you've put that into the allocation, how do you actually execute it? How do you put it all together, Ryan?
Now, this is where the discipline comes in.
Right.
Because the execution almost puts you back sometimes to the first stage, which is the asset allocation. Because that execution is the color within. How does it have to change? And sometimes that color needs to change so dramatically that you start back at step one, which is the asset allocation. But that's where your discipline comes in. That's where your confidence comes in, confidence in your system, confidence in your team, and that's where the results are made. So it's that also when it comes to execution, it's just a rigorous staying on top of it.
Right.
And being fluid, being like water. Don't get so committed to one mindset because you have to be able to adapt, especially in this market environment.
Right. So one thing that you and I have talked about, and we've got some different examples that we've used in the past, we won't get into those, But I think an important component is, how do you fly this whole thing?
Right.
When you have all these different risks, technical, fundamental, we've talked about all these different, objectives and things that can happen or the noise that's coming in.
Right.
How do we put it together?
Yeah. Well, realistically, the right answer to that might not be the answer that I give you today. Couple months down the road, it could be very different. Right now, we are in a very unclear environment. I don't know that the economy and that the financial markets ever are easy to figure out, but there are forks in the road. There are processes that play out. They have a start and they have a finish. Where are you at? There are more challenging environments to get that right than others. We are in a very challenging one right now. Is a bull market, a secular bull market, dying? Is it going to be prolonged? Again, it's cloudy out there.
Right.
It's cloudy. So if we're flying an airplane and we're in the middle of a bunch of clouds, you can't see out that cockpit window, what are you going to do? You're going to trust your instruments. Right now, we need to, number one, have the top of the line instruments. After all, it's very important business.
Yeah. Know
how to read them like a pro, and then to trust them and execute based off of what they're saying. I mean, if we're not listening to them, well, why even study them?
Right.
This is what will get us through this very cloudy environment. That's what will get us through this very challenging time where it isn't clear. And you know what? It's not just the lack of clarity, it's how quick something can change, how quick the headwind can turn into a tailwind and flip-flop back and forth. But yet again, the sooner you can realize that thing is changing or something is changing, the better you're going to execute for your clients.
You got to be monitoring it. You got to have a team put together. You got to have all these different things, even at the 30,000 foot view.
Even at the 30,000 foot view. So where are you going to pick up on these changes and rotations and things like that? It's on the instrument panel. And then we just walked through the portfolio construction process. That's in that constant monitoring and screening component. So again, I would say our tools, our instruments are firing every single day, and we listen.
Yeah.
We listen and we make sure that we know what they're saying to us. And again, it gives me confidence when I close my eyes at night because I take this job very seriously, and I want to be as informed as I can be.
Right, and we try to do it for you. We try to do it in a smart way, and we're going to kind of keep working those tools, working our instruments, and in these kind of time frames, whether it's the last 2 years, 2 months, 5 years. You've been with us for 2 weeks.
Yeah, well, and it gives us something to talk about at the water cooler.
I know, right? So one thing that we don't want to not talk about this month, because I think we've talked about it almost every month, are interest rates. I mean, I don't want to skip it.
Yeah. You couldn't, because I already led in earlier with, we know the culprit.
From October.
Yet again, I will say it again. Yeah. When interest rates are volatile, that's not good. So you don't want interest rates swinging around a whole lot. That means interest rate volatility translates to bond market volatility. But let's not even worry too much about that. Interest rates in general are designed to be the lifeblood of the capital markets. So, and I've said that numerous times. Yeah. Excuse me if I've said it to you before. But basically, when you think about low interest rates, velocity picks up, economic activity. But guess what that leads to? Inflation. So, you kind of raise interest rates, and that would put a lid on inflation. But that's just the Fed doing the Fed funds rate movement. That's the anchor point of this whole yield curve. There is a interest rate market out there. And that interest rate market is more buyers and sellers, supply and demand. So the Fed, when you hear the Fed raised interest rates this month, what that means is they raised the federal funds rate, which is the overnight lending rate that banks have with each other. That's the federal funds rate. But then the remainder of the interest rate world is driven by market economics. Okay? So a couple different things can happen. You can have like the Federal Reserve looking to stimulate things. They're going to step into that interest rate market and buy treasury bonds, load up their balance sheet, try and suppress interest rates. Well, what if they were more concerned about inflation and less that economic velocity and movement? Well, they're probably not buying a whole lot.
Right.
So then who else is out there buying? Well, recognize our government, we spend money. Spend plenty of money. So I'll throw a bone to the kind of those, not conspiracy theorists, but those who want to be critical of our government. And that's fine. I mean, we're running a very big tab.
Yeah.
Well, how do you pay for that? How do you pay for that? Well, how you pay for that is our Treasury issues Treasury bonds.
Yeah.
Well, if you're spending a lot of money, you need to take in a lot of money. So you really have to issue a lot of Treasury bonds.
Yeah.
Well, the Fed, they're saying, no, we're fine if the economy slows down a little bit. So we're not going to be out there buying those. So then we're looking for counterparties out there to be buying our government's debt. Well, if we have perceivably a lot of it out there,
Yeah.
how am I going to incentivize somebody to buy that next incremental component of debt?
They already think they got a deal. Why would I buy more?
Well, and so what do? Interest rates go up.
Yeah.
Now, the diagnostics behind it, we don't need to spend the hour there. But let's just say that when we're issuing a lot of debt to cover a big budget, well, rates are going to go up.
Yeah.
Rates are going to go up. And you're seeing that hit the markets more and more as we keep hitting, you get weekly pretty much Treasury bond issues. And I always like to look at the auction to see how it goes. And that then sets not the federal funds rate, but the rest of that interest rate environment. So again, it's one of those things where if we just keep coming to the market with Treasury bonds, be ready for interest rates to keep moving higher.
Yeah.
If we can maybe get a little bit of a handle on it, rates in general would slow down. So anyway, kind of unique, but that's one of the things that we're watching. You talk about instruments and tools. Watch the Treasury bond auctions.
We've got to pay attention.
Yeah. Were they firm? Were they soft? All those things. Yeah. So it's fun.
Well, pretty much everything we talk about, is things we can't control, right? The markets, this. We try to control what we can't control.
We can't.
No, the big thing, though, I guess I was trying to get to was, things that we can control are year-end housekeeping things,
yes,
right?
As important, too.
Yeah.
I mean, this is very important stuff. So, and you go ahead, run with that one.
Well, we have things like Roth conversions. So, it doesn't make sense for you specifically. That's something we can talk to you about. But it's something you might want to have on your mind. Maybe talk to your accountant, talk to us to see if it is something that you could take advantage of and if it makes sense for you. Something else I know we do a lot is tax harvest loss, right? Yeah. So, tough years, mutual funds might be, kicking out passive distributions. Well, how do we try to combat that? Well, maybe we can use something that might have a tax loss to try to offset some of those, taxes we might have to pay on that.
Yeah.
No one wants to have money go. No one wants to have their portfolio go down a little bit, and then they got to pay tax on top of that. So.
Well, and we have a name for it. It's called tax drag.
That's right.
Let's not, there's a way around it. A lot of it just requires communication. Anybody with an IRA doesn't necessarily have to think about it. But to James's point, taxable money. There's some movements and some things that we can get done for you. So,
and we're on top of those year-end things, trying to evaluate it for our clients. But if something pops into your mind, we're here for you.
Absolutely.
And I guess with that, Ryan, what are we looking at next month?
One of the things that we did not have on our list is earnings season has kicked off. Mm-hmm. So again, we'll be through that next month, so that'll be good. We can kind of look. I mean, October was a tough month. I wouldn't be surprised to see some technical positive things coming out of the next couple weeks, so we can study those and just forensically take a look. But here's the bottom line. It is cloudy out there. Mm-hmm. There is a lack of direction. Think about it. The market's really gone nowhere for, 2 years?
Right.
It's felt like it's gone everywhere.
A lot of noise.
It's
been loud.
So again, I think that it's time that we're really looking for that trend, that next trend that we can follow to be fleshed out here. So we'll see more of that in the month of November, and it'll be good.
All right.
So
we'll see everyone there. We'll see you there.
All right.
Thanks for being here, Ryan.
I think so.
All right.